Hello, welcome European listeners and market participants, and welcome to KBRA's latest European podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues across the various ratings teams here at KBRA. Today we will be covering recent developments in Europe, where we will ask the question of, are we facing a new European order? My colleagues and I will go through and attempt to provide some insights around this as we discuss the impact of the war in the Ukraine, inflation, central bank actions, government reactions, and how these will have an impact on various credit markets. This episode is the second of a two-part series. In our previous episode, we covered content from our sovereign financials and corporate credit analysts, which you can find in our podcast channel. Today, we are taking a look at the structured finance world and the impact that the situation has had across the various structured finance markets. At KBRA, we've been actively following the market developments overall, and we've been trying to be as proactive as possible in providing you with insights into the developments as they have happened. You can now follow our latest reports and related information on kbra.com, where we have commented on everything from ESG to airlines and the impact of these latest developments. As you can see, the current situation has adjusted the dynamics of Europe. And with regards to the corporate credit space, there have been various markets that have been more heavily and are likely to be more heavily impacted than others. Gabriele, perhaps you can take us through the impact that this corporate credit world will have and the current situation will have on the CLO market.
Yeah, thanks, Gordon. And hi, everyone. Yeah, let me say one thing. So while European CLO have not major direct exposure to Ukraine or Russia, however, the collateral is made of sub-investment grade loans, and these are made to highly leveraged corporates. So we would expect, therefore, that the negative factors that have just been listed by Garrett, so the higher cost, lower margin, will put downward pressure on the already high leverage debt ratios of this company and could impact, in some cases, their ability to service the high level of their debt. Now, how this compare, the current economic situation with what we have been through during the COVID period. So it probably is going to be very different, at least from a CLO perspective. So what we have observed that during the COVID, the distress was really concentrated in some specific industries. So the most impacted in terms of either defaults, but also rating downgrades, were transportation, oil and gas, and also casino, hotels, leisure, and entertainment. So the distress was really focused on these sectors. Now, with this crisis, which of course it really depends on the length and the depth of the conflict, the impact, I believe, will be felt across a wider range of industries. Although, of course, we would expect, to be somehow more prominent in more, cyclical business. Now, as the level of the correlation in the CLO portfolio increases, because of the external shocks that Garrett just said and all the other have listed, on the demand and on the supply side. So I think the focus would be more on the idiosyncratic risk. It will be on the ability of each individual high-yield corporate to deal with higher cost and reduce revenues at the same time. In this context, companies that have increased their debts in search for liquidity to sail through the COVID period could struggle again. Now, European CLO structure are both very well diversified in terms of industries, but also in terms of borrower concentration. So this characteristic helps structure to deal with sectoral stress, like the one for the COVID, but also in terms of individual corporate distress. In addition, the portfolio managers, they actively select the credit. And what we have seen is that during the COVID period, actually, the number of defaults in the underlying CLO were lower, slightly lower, I should say, compared to the entire universe of high-yield loans. Now, in this kind of environment, we do expect that the manager performance could vary potentially, with some managers doing better than the others, because they choose the right credit.
So we have some interesting times ahead of us for the CLO market, but just quickly, where do we stand today in the market?
Look, I think we do have a good starting point because, when I look at the risk of the underlying portfolio, and, sometimes we focus on the triple C rated loans because these are like really the riskiest piece. These have been diminishing constantly over the last year. In some cases, in the CLO that we monitor, these have halved. Most of the CLO that we see in the European market actually are close or above their target reinvestment par. That means that they have a very good level of over-collateralization to start with. This will help them to deal with any potential downgrade in the underlying collateral or to deal with defaults. Additionally, what happened last year is that there was a sort of frenetic refinance activity for corporate borrowers. That really means that some of these issuers push their refinancing wall farther in the future. That really mitigated short-term increase in their funding cost, which at the moment, until not long ago, they were at historical low. So this potentially could limit the number of default, at least in the short term.
Thank you very much, Gabriele. Now moving on to a related but different area of the structured finance markets, we take a look at the ABS market with Killian Walsh from our ABS ratings team, where in this market, you can find a real diverse portfolio of different types of collateral. The impact of the current market can really differ depending on the collateral. At KBRA, in the ABS universe, we rate many transactions in everything from autos to student loans to trade receivables to solar ABS and aircraft ABS, and the list goes on. Killian, perhaps you can walk us through some of the areas where the current situation is likely to impact upon portfolios.
Sure, Gordon. As you say, it's a broad spectrum, but I suppose starting with the broad generalities and an observation across ABS sectors is that the economic conditions and inflationary pressures that exist at the moment won't have an immediate impact, but obviously ratings will be and can be subject to volatility if those inflationary pressures persist. And kind of zoning into, as you mentioned, the wide spectrum of asset classes, in terms of those directly impacted by the Russian-Ukraine crisis, obviously one of the key ones is aircraft ABS. We note that of the 63 rated, KBRA rated aircraft ABS transactions, 29 of those have some exposure to Russian lessors. For the remaining transactions with no exposure, we consider the impact to be more minor, and we don't foresee an immediate impact. Other asset classes which have across the global KBRA's rated ABS book where there is certain Russian-Ukrainian exposure include 4 wholesale business securitizations, but again, exposures are under 2.4% by store count. There's a container deal with exposure less than 10 basis points, and certain TV and syndication and music royalty deals have exposure, but in those instances, it is also under 1%. We also have an international student loan deal, but again, that has less than 1% of exposures to students currently residing in either Russia or Ukraine. But speaking more broadly and looking at the broader kind of context going forward, as mentioned by, I think, most people, but specifically by Gabriele and Garrett, the effect of the conflict on global supply chains is likely to continue to exacerbate certain supply chain challenges that were already under some strain through the pandemic and will certainly have some impact on SME exposures and corporates. I think Garrett's alluded to the fact that SMEs and the impact on those will be driven by industry-based trends. Again, similar tones to the pandemic, where specific industry sectors are likely to be impacted more from rising commodity costs. And clearly, the SME's ability to pass those costs on will be key and imperative to their survival. It's likely that such supply chain challenges will impact receivables-based transactions as well, as disruptions and delay in shipment and procurement of certain goods will cause uncertainty in certain sectors. Kind of more broadly as well, the conflict has brought Europe's reliance on oil and gas from Russia, Ukraine under the spotlight, and this will likely lead to a policy-driven focus to shift to more sustainable-based energy sources across the continent. In fact, KBRA released a report on this topic on Monday titled Diminishing Russian Carbon Reliance, Funding the Household Renewable Transition in Europe. This report highlights that the challenges associated with transitioning away from the dependence upon Russian energy and accelerating the migration to carbon neutrality have come to the fore with the onset of the war in Ukraine. There are many challenges to this transition. One necessary area of focus is the opportunity for households and small businesses to participate in this transition. This may see asset classes that heretofore have been present in the US more predominantly, such as PACE and solar loan and lease transactions, gain more momentum in a European context. Finally, and I know it's been a trend throughout the discussion today, I referenced the inflationary pressures that are likely to persist across Europe, at very least in the short term. So in terms of the consumer, the impact will become more pronounced as this persists. And KBRA continues to monitor this closely and remains in discussions with its various originators about their ongoing underwriting strategies and changes to same. We have observed relatively strong performance to date, despite the backdrop of COVID, helped by significant government stimulus. And this put consumer ABS transactions in a relatively satisfactory position entering this new inflationary environment. Significant inflationary pressures that persist will likely to put ongoing pressure on affordability, which is something we're monitoring quite closely.
Very interesting, Killian. Thank you. Not only will, as you highlighted, not only will businesses face challenges, but so will the consumer side. Homeowners, of course, will not escape any challenges as they face the highlighted higher inflation and energy prices and even rising rates. At KBRA, we've been active in rating mortgage portfolios in Ireland and the UK with the RMBS team led by my colleague, Kali Sirugudi. Kali, maybe you could take us through your views on how you see the impact felt by mortgage borrowers and homeowners.
Thank you, Gordon. I wasn't mute. Apologies for that. Okay, so as far as the RMBS performance is concerned, we are looking at two separate sectors in the RMBS space, the owner-occupied loan sector and the buy-to-let sector. And both these sectors are expected to be affected by an increase in delinquencies, given the background we have of the expected higher cost of living and the expected increase in mortgage interest rates. Specific to owner-occupied, the increase in delinquencies will be observed more for variable rate loans, loans recently restructured, and loans to borrowers who are categorized as vulnerable. Now, lenders and servicers are expected to offer suitable moratoriums or offer alternate arrangements to pay before any thought of foreclosure. Any increase in defaults are expected to lag 6 to 18 months after a failure of a restructure in the UK and relatively longer in Ireland and other jurisdictions. Now, again, on restructures, we've observed that lenders and servicers look at the disposable income available to a borrower and which is expected to contract in the current scenario. So KBRA certainly expects that there will be relatively more restructuring activity as far as delinquent loans are concerned. Moving to the buy-to-let sector, the performance here can be expected to be relatively better as compared to how the owner-occupied sector may be affected. Buy-to-let loans in general have a cushion to absorb rate increases. You generally see origination criteria where the affordability is tested on a minimum coverage of 125% for the monthly repayments. And then further, a stable expected performance is also supported by the observed increase in private residential rents, which is common to UK and Ireland as well. Of course, big cities like London in recent times haven't seen growth in rents at all. So there may be loans outstanding there, which may relatively be more affected. Many landlords have actually locked in rates with increased 5-year fixed take-up in recent years, as evidenced by the 5-year fixed rate concentrations in buy-to-let transactions. And that means that these landlords will be insulated for a time from any rate increases this year or the next. And lastly, what we observe specifically in the UK, that landlords with a portfolio of properties are expected to fare better, notwithstanding some delinquent tenants, which is also a phenomenon observed during the pandemic period, where a lot of tenants were not able to keep up with the monthly repayments. The severity and the length of the inflationary period, and if an economic recession or an increase in unemployment may mean that mortgage borrowers in general are affected worse. But the likelihood of these is currently unknown. So we reserve any comment on that for the moment. As far as the KBRA rated RMBS transactions in the UK and Ireland are concerned, a rise in delinquencies or restructures may not necessarily affect the payments on the liabilities of issuers adversely. Now, issuance structures in RMBS are usually supported by reserve funds or other liquidity features, which is common to what we've observed during the pandemic period, where there was rise in delinquencies, but then there were no necessary liquidity issues for payment of liabilities by issuers in RMBS transactions. A reversal in the current inflationary trends and or end to the war may mean that the mortgage sector is amongst the first to rebound, given borrowers' priority to service a mortgage debt. A quick word, Gordon, on just house prices. Since the beginning of the pandemic, house prices in most jurisdictions in Europe and UK specifically, have risen. The rise ranging between 5 and 24%. The house prices were supported by the increased savings rate over the pandemic period and a low interest rate environment, and an urge for homeowners to move away from city centers to relatively bigger properties with a garden, etc., given the benefits of space given lockdown. Now, going forward, KBRA expects overall housing transactions activity to diminish with modest decline in house prices over this year and the next. And this will be driven by the fact that you're expecting reduced affordability for house purchase, which in turn is driven by increase in cost of living and interest rates. KBRA expects first-time buyers to postpone house purchase decisions for a more favorable economic environment. Severity of any house price decline will depend upon, I've made the statement about how performance may be affected beyond KBRA expectations. Now, that's dependent upon that severity of inflation and any prolonged high inflation combined with an economic recession. But the likelihood of these is, as I said before, currently unknown. And lastly, the supply of housing units in the jurisdictions we've been monitoring across Europe and UK, that supply still remains at low levels in most, and which may be the only factor supporting house prices. With that, I hand it over back to you, Gordon.
Thank you very much, Kelly. Now, last but not least, we turn our attention to the commercial property lending market, where again, KBRA has been very active in Europe and in the US. Stephen Hughes heads our efforts in this space. Stephen, what can we expect in terms of the impact here? Is it fair to say that Russia's invasion of the Ukraine will have a relatively limited impact in commercial property?
Yeah, by and large, I think that's correct. We're certainly seeing an increase in market risks, so that impacts the pricing and timing of CMBS transactions and bonds. But on the credit side, there's no direct exposure to Russia, Ukraine. There's no properties based there. There aren't any large Russian or Ukrainian sponsors or lenders or counterparties or occupiers, etc. But that said, it kind of depends how the economic conditions unfold. So if we do enter a recessionary environment and it can impact the broader economy, then it is conceivable that some ratings could come under pressure. The other trend, which kind of follows on really from ESG, is this really heightened sense of reputational risk from parties being associated with what I call them kind of undesirable stakeholders. So previously, we started seeing investors being very wary to invest in schemes that are linked to heavy polluters, for instance. They might start to feel the same way, sanctions notwithstanding, investing where you have tenants linked in some way to oppressive regimes.
So European CMBS, though, is predominantly a floating rate market. So will the interest rate rises have any major impact on the space?
Well, loans typically hedged via a cap, so we would expect strike rates to increase there. And as interest rates do increase, or if they do increase, expect to see lower interest and debt service coverage levels. So that could impact that on that side. It may impact refinancing, although current leverage levels really aren't a major concern in CMBS, and debt yields remain by and large robust. Depending on the magnitude of the rises, yields could start to come under pressure, although there is still a buffer between the risk-free rate and prime yields, so that property risk premium. many yields for property types are at all-time lows. So if we did see a 25 to 50 basis point realignment, that could have a correspondingly large impact on values. Now, with regards to our own KBRA values, they are typically 25 to 40% wider than the current market. So we do have some cushion already built in.
So inflation's been mentioned many times over the course of this webinar. So would rising inflation be viewed positively or negatively for commercial real estate?
Well, it depends. I mean, historically in commercial real estate was seen as an inflation hedge. So as inflation rises, you can pass on that into increased rents. However, this will not likely be universal, and we'll see the affordability of certain leases will come into question. So where you have long-term inflation-linked leases to tenants with strong covenants, then definitely, rising rental levels are viewed positively as it leads to stronger cash flows. And we see this in many logistics or retail warehouses or multifamily leases, which can have annual inflationary uplifts linked to CPI or RPI, especially in continental Europe. The flip side of this is the rising costs, especially for operational assets such as hotels or care homes or cinemas, which may not be fully stabilized coming out of COVID. So they, along with discretionary retail, may struggle to pass on increased costs to the end user. And if they are forced to absorb those costs, expect them to try and exert some downward pressure on rents going forward. Inflation could also negatively impact the development sector as costs for raw materials rise and ongoing deliveries get delayed as well. So more scrutiny on CapEx plans or those unstabilized loans that we may start seeing in CRE CLOs going forward.
Thank you very much. As our analysts have discussed, the current situation and the dynamics of Europe are changing, and the impact that they are having across structured credit varies to a great extent and depends upon the impact on the various collateral types. But I would summarize the discussion to say that overall, the inflationary trend that we are seeing has been accelerated. The risk of a slowdown has increased, and the impact on the markets across structured finance differs, but to their benefit, they are generally coming from a position of strength. Consumers have high levels of savings, low levels of default, and are coming from a very low rate environment. Yet the direction has changed, and how far that change migrates has yet to be determined. We here at KBRA are actively monitoring the markets and will keep you updated. Make sure you are registered on our website and have subscribed to our podcasts and are engaged with our analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Don't forget to subscribe to the podcast, and we wish you all the best in the coming months.